All right, so you're looking at commercial real estate, specifically in Chicago, and you want to make sure you're, making smart decisions, naturally. You've brought in some really interesting material from Michael R. Linton, who seems to really know his stuff.
Yeah, Michael's a bit of a pro when it comes to Chicago real estate. He's a commercial broker and investor, and he's got this website, chicagodealflow.com. A lot of great insights on there.
Okay, so he seems to be a big proponent of using this thing called cap rate to evaluate potential investments. For those of us who haven't been in the real estate game that long, how would you explain cap rate? I mean, I understand it has something to do with potential return on investment, but could you unpack that a little?
Okay, so imagine this. You're comparing two properties, right? One is a brand new office building downtown, all sleek and modern. The other is, say, a multifamily building in a really cool up-and-coming neighborhood. Cap rate helps you cut through all the noise, the location, the amenities, all that, and just see, okay, based purely on income and property value, which one offers a potentially better return.
So it's like a quick snapshot of earning potential.
Exactly. And it's expressed as a percentage, which is really handy because it lets you compare those two very different properties we were just talking about, or even, a retail space versus an industrial warehouse. Apples to oranges, but the cap rate gives you a common language. And generally, the higher the cap rate, the higher the potential return on your investment, at least on paper.
That makes a lot of sense. Okay, so let's get into the nitty-gritty. How is this cap rate thing actually calculated?
It's surprisingly straightforward. It's just a simple formula. You take the net operating income, or NOI for short, and divide that by the property's market value. Then multiply by 100 to express it as a percentage. Boom, there's your cap rate.
Okay, so I got NFI on top. Just to refresh my memory, what all goes into calculating that again?
Right, so NOI is essentially the annual income a property generates after you subtract the operating expenses. Things like property taxes, maintenance costs, insurance, all the costs of actually running the property.
So it's like the money you're left with before you even think about mortgage payments or anything like that.
Exactly. It's all about the income potential of the property itself.
Mm.
So let's say you're looking at that multifamily building we mentioned earlier, and it's listed at $5 million. The projected NOI for the year is $400,000. Divide that income by the price, multiply by 100, and you get a cap rate of 8%.
So in that scenario, an 8% cap rate would be what you'd use to then compare it to other similar properties.
You got it.
Yeah.
But now comes the million-dollar question. What even is a good cap rate? And that's where things get really interesting.
Right, because what's considered a good cap rate in one market could be totally different in another, right? Like, even within Chicago, I imagine a property downtown versus, say, out in the suburbs, those cap rates could vary wildly? No.
Oh, absolutely. Location, 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 as they say.
Yeah.
It all boils down to risk. A prime spot, like a storefront right there in Wicker Park, that's going to be seen as a safer bet than a similar property further out, maybe with less foot traffic. Investors are more comfortable with a lower potential return, aka a lower cap rate, if they see it as a less risky investment.
Less risk, lower reward. Gotcha. But it's not just about the zip code, right? What other things should people be thinking about when it comes to this whole cap rate thing?
You hit the nail on the head, it's multi-layered. Thankfully, Michael goes really in-depth on this in his work. One major factor is the property's condition, of course, like a fully renovated building that's going to generally have a lower cap rate than one that needs a bit of love, maybe some updating.
So a fixer-upper might scare some investors away, which could lead to a higher cap rate.
Exactly. You got to consider the tenant situation. A property with good long-term tenants, that's a dream. Right?
Yeah.
Steady income stream, less risk of vacancies that contributes to a lower cap rate as well.
Less turnover, less risk makes sense.
Think of it like this. Would you rather have a property where you constantly have to find new tenants, or one where you've got reliable folks locked in?
Definitely the latter.
Of course. But let's not forget the bigger economic picture. Interest rates, for instance, those can really throw a wrench in the works. When interest rates are low, borrowing money is easier, which often pushes demand up and cap rates down.
So it's almost like a domino effect. A shift in the economy can ripple through the entire real estate market and affect cap rates. You mentioned that it's important to consider cap rate as one piece of the larger investment puzzle. How can someone actually use this information? Like if I'm looking at properties in Chicago, how does cap rate actually factor into my decision making?
Great question. For one, it's a really useful tool for comparing opportunities. Say you're considering that Wicker Park storefront we talked about earlier, but then you also see a multifamily building up in Ukrainian Village. Cap rate gives you a way to compare apples to oranges, essentially. Different locations, different property types, but you can see how they stack up in terms of potential return.
So it levels the playing field a bit.
Precisely. And it can also help you uncover some real hidden gems. Let's say you come across a property, and the cap rate is noticeably higher than others in the area. That's something to pay attention to. Now, there might be a good reason for it, like it needs a ton of work, but it could also be a sign that the property is undervalued.
Ah, so a high cap rate could either be a red flag or a golden ticket. You really have to dig deeper.
Exactly. It's all about understanding the context behind those numbers. And that's where someone like Michael, with his deep knowledge of the Chicago market, becomes invaluable.
It really is about looking beyond the surface, isn't it? Those numbers can tell a story if you know how to read them.
Absolutely.
Yep.
And cap rate analysis, it can actually be a powerful tool, even when you're negotiating a deal.
Oh, interesting. So instead of just going back and forth based on like gut feelings, I can actually come to the table with some hard data to back me up.
Exactly. When you use cap rate to support your offer price, you're showing the seller, hey, I understand the income potential of this property. I'm not just throwing numbers around.
It's about making smart, informed decisions, not just relying on emotion. Okay, so let's say I've closed the deal. I'm officially a commercial real estate owner. Do I just calculate the cap rate once and then, like, file it away?
That's a big mistake a lot of investors make. Regularly calculating your property's cap rate, it's essential for tracking its performance over time.
Because things change. The market fluctuates, interest rates go up, interest rates go down, even the neighborhood itself can change, right?
Exactly. And those changes, they can impact your property's value, its income potential, everything. By keeping an eye on that cap rate, you can spot potential issues early on, or even identify opportunities to, maybe improve things and boost your returns.
Stay ahead of the curve. So I'm monitoring my cap rate, I'm staying informed. When does this metric tell me, okay, it might be time to sell?
That's a great question. Sometimes shifts in cap rate can actually be an early warning sign of bigger changes in the market. If you start seeing cap rates for comparable properties trending downwards, it could mean things are cooling off.
So it's like a canary in the coal mine almost.
In a way, yeah. Obviously, you wouldn't make a decision based on cap rate alone, but it's definitely a valuable piece of information to have in your back pocket.
This has been so insightful. Michael R. Linton, everyone, over at chicagodealflow.com. Definitely check out his work if you want to learn more. Any final thoughts for our listeners who are ready to, jump into the exciting world of commercial real estate?
Remember, knowledge is power, right? The more you understand these key metrics, like cap rate, the better equipped you'll be to navigate the market, make smart decisions, and hopefully see some great returns. And, of course, never underestimate the value of seeking guidance from experienced pros like Michael.
Couldn't agree more. Having the right tools and information, that's how you succeed in this business. A huge thank you to you. This was fantastic. And to our listeners, thanks for tuning into this deep dive into the world of cap rates. Until next time, happy investing.